Welcome to the PIWORLD interview recorded on Tuesday, 29th of June 2021. I'm your host, Tamsin Freeman, and I'm here today with Stuart Widdowson, Managing Partner of Odyssean Capital. Stuart, many thanks for joining us. Can you tell us a bit about your background?
Thank you, Tamsin. I've been investing in quoted equities since about 2006, and I probably most well known for running an investment trust called Strategic Equity Capital from mid-2009 until 2017. Through that period, I executed the investment strategy we run here at Odyssean, and I helped lead a significant turnaround in performance of strategic equity and a significant narrowing of the discount over that period. I set up Odyssean with a number of former colleagues in 2018 who all came from HG Capital, which is a mid-market private equity house, and that's where I spent the first part of my career.
And so how did the Odyssean Investment Trust come about? Were you all out for a beer one night and just thought it would be a good idea? Or how did it happen?
So I think unusually, a lot of the people around our business have spent a lot of time managing investment trusts over their careers, and we think it's an excellent long-term savings vehicle. You can compound returns very effectively, and it really is good long-term capital that you as a fund manager can really take long-term decisions with. So we're all real fans of the investment structure. A number of the former shareholders of SEC had contacted me and were keen to back me in the new venture as well. So it's very difficult to get an investment trust off the ground and launch, and we were very fortunate. We had lots of people who were prepared to back us. So they are great long-term savings vehicles and great funds to manage as a manager as well.
So you've got a joint venture with Harwood Capital. How does that work?
So Harwood Capital was one of the organisations that approached me to help set up the business. They provided seeding for the business to get the business started, but also they are the second largest shareholder in the Odyssean Investment Trust. What they do for us, they provide everything that's not investment or portfolio management related and marketing based. So they provide our back office, our mid office, and the infrastructure, the building that I sit in, the IT. And the real benefit is that my colleague Ed Wilhofsky and I, we spend all our time focused on investing in clients. So it really takes a lot of the hassle factors out of running your own business.
So you share an office with Christopher Mills, effectively?
I don't share the same building, but we have our own dedicated office within the building. And Christopher is a non-executive on the Odyssean Capital's board, and I guess is the biggest shareholder. So,
and who else is on the team with you?
So we have three of us who are on the research committee. There's Ed Wilhofsky, who also manages OIT with me. He is a couple of years younger than me and worked at HG Capital for longer than I did, and has a real sector expertise in the TMT sector. He's been with the business since we launched. And then our chairman of the asset management company is Ian Armitage, who used to run HG Capital and was highly influential in really establishing HG Capital Trust. So Ian is part-time. He sits in our research committee and basically helps Ed and I with investments. One of the things we believe in really with the private equity heritage is skin in the game. And between Ed, Ian and myself, we own personally about just under 10% of the trust's equity as well.
And what sort of return are you trying to achieve each year from the investments?
So the way we think about trying to invest clients' money is different to many fund managers. We're not out to beat an index. We're there to compound people's money in real terms over the long term. And we aim to double clients' money every 5 years, which is the equivalent of about 15% annualized return. And that's really what gets us out of bed. It's that focus on trying to make money rather than beat an index.
And is that what you've managed to achieve over the first 3 years?
Yep. So we went through the first 3-year milestone at the end of end of April, and we're absolutely delighted. We've hit that target on a NAV basis, and even more pleased. It's been a period where, as you're aware, markets have been very interesting over those 3-year periods. We've pretty much seen 4 seasons in 3 years of exuberation, panic, sideways markets. And so not only have we hit the absolute return target that we set out, but also we've done significantly better than the broader market, which we're delighted about.
Very good. And you say that you combine the best of private equity investing with public equity investing. What's the differences and what are the strengths and weaknesses of both styles?
Mm-hmm. Well, the styles, as you mentioned, Tamsin, are quite different. Most public equity funds, the majority of assets are in daily dealing, open-ended UCITS funds, which means that managers are having to manage money coming in from clients and money going out from clients every day. In terms of the portfolios they run, they're pretty diversified. So many quoted fund managers run portfolios of 100 stocks and manage risk through the diversification. It's easy to buy and sell. Daily liquidity means in the underlying, or seconds liquidity means you can, if you like a share, you can buy it. If you don't like it, you can sell it. And the companies you tend to invest in have relatively low gearing. Now, where we're unusual in that regards, we do actually run our money in an investment trust, so we do have the benefit of permanent capital in investing in this style. If you look at private equity in comparison, they tend to have very long-term locked-up capital. They don't have the daily dealing issues that many quoted fund managers have. They tend to be the biggest shareholder and the dominant shareholder in the companies they manage, rather than typically owning maybe a few shares or 1 or 2%. Rather than being jack of all trades, most PE houses tend to be very sector-focused. So they'd rather know a lot about a small number of sectors rather than a little bit about the whole market. They're very, very selective. They might only make 2 or 3 new investments a year and have a portfolio of maybe 10 or 15 companies. But more importantly, the companies they invest in, they're going on a change agenda. They're trying to make money, not beat an index. And they're trying to buy an asset and sell it in 3 to 5 years' time where something has changed positively. We pull that together in the way we approach investing. So we don't make very many investments a year like a PE house. We tend to make 4 or 5 new investments a year. We have a very concentrated portfolio of typically 15 to 20 stocks. We have semi-permanent capital in the investment trust, which allows us to make those long-term decisions. And we're sector focused. So we spend most of our time looking at assets in the healthcare, TMT, specialist industrials, and business services sectors. So again, we'd rather know much more about a small number of companies and a small number of sectors rather than trying to invest in the whole market.
That makes sense. So what attributes are you looking for in those companies in which you invest? And give us examples of how that manifests.
Absolutely. So the key thing we come back to is basically, can we make money out of this investment as opposed to beat the index? But there are 3 key things that we're looking for in every investment opportunity. Is it a good company? Is it an attractive valuation? And can something be done to improve that company whilst we're a shareholder? And if I can take those 3 things in turn, in terms of quality, we're not interested in buying cheap, bad quality assets. We ideally like to invest in companies. If anyone remembers Victor Khayyam, I like the business so much I bought it. Remington, we like businesses that conceptually we'd be really happy to be 100% owners of for the long term. Because in small companies where we tend to operate, liquidity can come and go. And even if you want to sell the stock, you might not be able to. So you've got to reinvest in companies that you think are good. Now, there are lots of ways we look at that, but one of the key things we look for is some element of market leadership. And we really, really like market leaders. And we like niche businesses that do things that are difficult for other people to do themselves or enter that market. We like companies that have the potential to make good margins. So we don't really invest in companies that don't have the potential to make at least 10% return on sales. And we want companies that have got some element of growth. They don't have to be massive growth companies like, ASOS or Boohoo or Fevertree. We'd far rather have a lower rate of growth that's more stable and more sustainable. We're not interested in sunset industry companies that are printing or newspaper distribution or things like that, because ultimately those are declining businesses and it's very difficult in our experience to make money from that. So once we've found and assessed what we think is actually a good business, the key thing then on investment is making sure you don't pay too much. And we're not value investors, but we're looking for really two different parts of valuation to basically make an investment interesting for us. The first is basically buying at what we believe to be below intrinsic value. As in, you're buying £1, but you're actually paying only 80 to 85p for it. Now, how do we assess that? We don't just look at quoted market metrics. We through our experience of working in private equity, Ed, Ian and myself, we've not just looked at buying assets for private equity funds. We've also been involved in sitting on the boards of those companies and trying to sell them later on to trade and other private equity buyers. So we've got a pretty good view of how the world values assets, as in non-stock market investors, but also what attributes make those companies attractive and what makes them unattractive. So as well as the numbers base, we've got a pretty good view of the characteristics that private equity and trade buyers like.
So what attributes is it that buyers do like and are looking for?
So a lot of the attributes that go into our selection actually on quality: market leadership, typically high return on capital, attractive market dynamics, and market dynamics as in typically growing, and doing things that are difficult for other people to replicate, companies that have got a sustainable long-term franchise, and ideally maybe with consolidation opportunities where the base company can add value through doing M&A.
But isn't everyone looking for those opportunities, particularly when they're priced at 85p and are valued and are worth £1?
Well, absolutely. What we tend to find is a lot of the change situations that we get involved in, we like the companies that maybe have the potential to be there, but actually are not, an anecdote, they're not firing all cylinders at the moment. And the potential and the qualities are maybe being overlooked because there are some short-term trading issues, or, maybe the company's slipped on a bit of a banana skin. And a lot of the broader market is typically evaluated on short-term performance. And they might say, actually, I don't want to invest in this yet because it might not do well for the next 3 months or the next 6 months. We'd look at a situation and say, well, actually, if you've got anything longer term, it doesn't matter what happens next 3 or 6 months. If you think you might double or triple your investment, the first 3 to 6 months doesn't really matter. And actually, if it takes a while to build your stake, you've got to start buying it a little bit when no one wants it. So quite often, we'll buy an asset that the market doesn't like at the moment, but in 3 or 4 years' time is quite happy to pay double the price.
So you're seeing attributes and catalysts for change before the market's seen them. So I know you've got quite a large position in Flowtech Fluidpower, and that's gone nowhere for a long, long time, really. I can remember seeing them back in 2015, and I'm interested to know what's changed in the recent past, or as you were buying into it, that was the catalyst that made you think this is going somewhere?
I think from a quality of business perspective, it serves a niche. It's involved in distribution of hydraulic and pneumatic parts, and it's a master distributor. It's the UK market leader in its space, and as the UK market leader, it should be taking share over time. What had happened prior to our investment, you're absolutely right, it had floated in 2014, and it had gone out and done a reasonable amount of M&A to attempt to consolidate. But it's a situation we find quite a lot in small companies. A lot of them do M&A, but they don't get the value out of what they bought, and then suddenly the wheels come off. And that's basically when we looked at taking a stake, because we felt that the core business wasn't generating the organic growth it should have been, and on top of that, wasn't making the margins it should have been because it hadn't integrated what it had bought. It was below the radar of a number of investors because of size, and it also had a dividend policy that was too generous. Basically, it was paying out too much capital, and as a result of that, to do the M&A was having to issue lots of shares, which was quite dilutive. So there were a number of things that weren't quite right. The margins were interesting. So a big part of what Ed and I do in our due diligence is benchmarking companies and looking at business models and saying, actually, given what this business does, given where it sits in the supply chain, and the value it adds, what types of margins do competitors and similar business models make, and what does this business make? And Flowtech was making very low teens margins. So it wasn't a basic distributor like a Brammer that some people might be familiar with. It was more akin to something like a Diploma, which was making high teens margins. So there was a performance gap there, and that got us quite interested. We started to do more due diligence, and it turned out that in that case, they hadn't really integrated the acquisitions. They hadn't looked at reducing overheads of the combined group. And in terms of purchasing, they had, I think, 12 or 13 different parts of the business buying the same components from the same suppliers, but they'd never gone through and integrated and worked out whether they were paying the same price for the components they're buying in and on the same payment terms. So there's a big opportunity to basically harmonize all of their systems and purchasing, and also take out overheads from a lot of duplication of sites. So we saw a performance improvement opportunity. The second thing was actually a push on organic growth, and we felt that as the market leader, they had the capacity to grow faster than the market and also be one of the leaders in moving what's historically been an offline sort of catalogue telephone business to much more online self-service. We, as the largest shareholder, it's public information since we became a shareholder, there's been some board change there, and a relatively new chairman was put in quite recently, and that's an individual that we've worked and backed with over the years, who really understands distribution and lives quite close to the company. So if you take a step back, performance improvement, yes, cost out opportunity, better purchasing, potential for transforming the business model to being, much more of an e-commerce online business in a sector that's historically massively lagging behind the consumer sector.
So do you come along and see the opportunity almost beyond what management can see, and then bring in management like Roger McDowell or whoever it might be, in order to start to realise what you think the potential is? Or are management already starting to do that, and that's what gets you interested?
Look, I think it's a bit of both, and it depends on how much we own of the company. So Flowtech, we know Roger pretty well, and we were delighted when he became chairman. If I look at a different situation, so we were quite big investors in a company called SDL. It's a big portion of the fund. We were a relatively small part of the company. I think we owned about just under 3% of the equity. SDL was a global market leader in translation services and software, and through Ed and my experience of looking at businesses like that have a mixture of services and tech, where they're a market leader, those businesses should make high teens operating margins. SDL, similar story. It was making 9% operating margins and had done lots of M&A, and we felt that a lot of the benefits of that M&A hadn't really come through. Now, a new management team had come in there. It was the first investment we made for OIT just over 3 years ago, and we were trying to work out why the company wasn't making the margins it should have been. And there were two real opportunities that after an hour of meeting management, we realised there was a lot of upside that wasn't priced in. The stock was priced for no improvement in margins. The first thing was they had several thousand translators in-house that were managed by, the resource of that was managed by an Excel spreadsheet, and it was very inefficient. So the utilisation was lower than where it should have been, and they weren't able, we felt, to price work as effectively as they could do. And the company had embarked on developing a system to actually schedule work in a much more efficient way called Helix. And we felt that had the potential to significantly improve the gross margins of the company. So we saw that as a big opportunity, and we'd seen it before with other companies we've invested over time. So we had a sort of a template for understanding the upside from that gross margin. The second was overheads, and in keeping with many companies that have grown up through M&A, a lot of the back office integration hadn't been done. The cost base of the company was around 230 to 240 million pounds at the time, and 100 million of that, it transpired from our meetings with management, had been unallocated central costs. And what we know from our experience of other companies is if costs aren't allocated, they're not managed, no one owns them, and they're not efficient. We got quite excited, and from our own experience, again, I've seen this before, we asked them whether they were going to carry out something called a zero-based budget. Now, if you're not an accountant, a zero-based budget doesn't take last year's costs and add inflation. It goes around and says, actually, we have 270 million of turnover. What's the cost base that we should be running that turnover on? So it starts from what costs do we need to run the business rather than what costs are they today. And in our experience, when companies go through that process, they typically take 10 to 20% of the cost base out. So we asked the CFO whether they were considering doing that. And she said, that's really interesting. We're starting that process next week with one of the big four accountants. And Ed and I got really excited because we felt that there was a clear route map to how gross margins could improve and overhead costs could reduce as well. And we realized the stock market wasn't pricing in any improvement. And what happened, the company went partway through its improvement, and it ended up being acquired by one of its trade peers.
And RWS saw the opportunity that you'd seen.
Absolutely, yeah.
So what are you expecting in your current portfolio? Which are the most likely takeout targets now?
Well, the only certainty about M&A is you can't predict what's next. I mean, I think, and we don't pick stocks because we think they're going to get taken over. What we tend to find is if they don't re-rate, they attract bid interest. Alternatively, things don't go so well, and, you know, I don't know, a company has a profit warning. If it's an attractive asset and the stock market punishes a profit warning, quite often companies get bid for afterwards. So we don't pick companies because we think they're going to get taken out. It's an outcome of our process. Look, we talked about the attributes that PE and trade like. It's as much about attributes they don't like. So we don't have companies with pension deficits, which is a block. We don't have companies with blocking shareholders because that's a block to take out. In reality, anything could be taken over. It's difficult to put your hat on one.
And Elementis also had a bid for that. In fact, it's had quite a few. What do you like about Elementis, and what do you feel about those bids that it's attracted?
Yes, well, Elementis was one of the two industrial companies we bought last year. You know, it became grossly mispriced. The thing we like about Elementis is, unlike many industrial companies, Elementis is master of its own destiny because it actually owns its own source of raw materials. It's a specialty chemicals companies for people who don't know that well. And the key resources it's got are the world's highest grade and only commercially viable hectorite clay mine in California. And this is used by them to formulate into a product which helps the rheology, which is basically the liquid characteristics of typically personal care products. So it's a very low cost of the end customer cost base, but has a material impact on the performance of that, which is the sort of thing we like. The second big asset it owns is the world's highest grade industrial talc mine in Finland. And both like that industrial talc mine and also the hectorite clay mine, they've got decades of supply. If you believe inflation is coming back, and I know it's something you want to talk about later, if you can own your own source of raw materials, you're master of your own destiny. You can control your pricing, which we really, really like, and it's strong asset backing. On top of that, the other thing we really like about Elementis is the company is going through a multi-year process of self-help and improvement. There is a factory move going on where they've been consolidating some of the sites and reducing capacity in the States and moving some of it to India in a much lower cost environment. And that has the potential to have a step change on profitability. But on top of that, they've been really driving new product development, and the drop through of launching new products, so in the profit drop through from incremental sales is very, very high. Now, if you put that all together in the numbers, you know, we've commented publicly that lots of things in the consumer sector are pricing in perfect recovery. Elementis is not pricing in perfect recovery, and although it's recovered very well from the lows, the shares are still around half the price of their peak. So we think there's a lot more to go for. If you just do the raw maths, the operating profit forecast for next year, I think, are about $140 million. In reality, the peak in 2018 was about 154. They've taken out almost 40 million of costs since then. And on top of that, the contribution for the new products has the potential to add at least 30 million of profits. So we see peak profits on the recovered cycle, even without inflation, of being way above $200 million. And the market forecasts are substantially lower than that. So recovery is no way priced into the stock, which, going back to the M&A approaches, not surprising that somebody else has seen the opportunity. We were very happy, and we were happy to back the board's rejection of both the offers, which we thought were basically far too low and very opportunistic.
What would you have accepted?
There's always a price for everything. The board put out in their defence document that probably the company was worth in excess of £2 a share. That was back in December, and at that time we didn't disagree with that.
And don't you think it's got rather high debt? That doesn't bother you? Well,
interesting. Debt can be appropriate for some companies, and in the case of Elementis, we talked about the long-term reserves, the mineral reserves in the ground. It's a business that can cope with gearing, number one, because it has that tangible asset backing. But on top of that, it's very, very cash generative. Now, one of the things, again, we liked about this is many industrial companies, when the cycle turns down, the cash flow is actually very good because they release capital from inventory and the debt has come down, and their cash conversion in a bad market is typically way above 100%. The problem is when the market recovers, their cash conversion is very low, typically 50 to 60%, because they rebuild inventories and the debtor book goes up again. Because of Elementis' business model, it's not like that, whereas its cash conversion through the cycle and on the upswing is much, much closer to 100%. So it will pay down that debt very quickly from its free cash flow. So we'd see debt going back to sort of more normal levels within 12 months or so. And then that's a significant catalyst for a re-rating from the market as well, as they see that debt coming down.
So where do your ideas come from?
Oh, a whole bunch of areas. I mean, Ed and I, have worked around small companies for 30 odd years. So many of the companies that we look at, we've known for a long time, and it might take, 5, 6, 7 years before we decide it's the right time to invest. So we have a watch list of things. We also have a network of industrialists we speak to. And in fact, we have 3 of them on a permanent advisory panel. So we speak to them about ideas. And then on top of that, it's just reading. You see a situation that's interesting, a whole bunch of different areas. We do some quantitative screening as well sometimes. There's lots of ways things get into the hopper.
And how long do you spend researching one of your ideas? And then what are the catalysts for you to buy into it?
So we don't make knee-jerk reactions because, again, we have the joy of basically being able to be patient. So the shortest time would probably 3 weeks from an idea coming into investing. In some cases, as I mentioned, it could be years. What triggers the decision to buy? Well, we're looking for, I guess, the right time and the right valuation and the right change that has the potential to come through. The way we think about each investment, and we have a detailed process we go through, is really comes back to this: can we make at least a 15% annualized return out of the stock? So you might find a stock that has all the attributes you like, but actually is priced for perfection. That's not interesting. We'll put it on the watch list, and if the share price maybe falls or goes sideways and the business improves, it comes into, from a numbers perspective, comes into working for us. So it can be a whole bunch of reasons, what triggers the decision to invest.
So something like Xaar you were buying into last September, and you commented that you wish you'd been buying in when Andy Brough was buying in. How long had you been looking at that, and what drew that to your attention?
Xaar is a fascinating story. If any of your followers watch it, it's been sort of boom to bust or feast to famine over pretty much 2 decades. And funny enough, I first looked at it in 2006 or 7. So it's a company that's been, on the watch list for a while. Ed and I met them in 2018, and I think it was evident to us there were a few issues going on, which meant that interesting IP, but maybe then wasn't the right time. We like going on site visits and visiting companies, and I think we'd had 3 or 4 successive cancellations of site visits on short notice, and then profits warnings coming out within a few days afterwards. So it went from being on the watch list to not sure we want to go there, and the company bluntly became too small for us. We tend to really only invest when companies tend to get to sort of 100, 150 million or so market cap. What happened in September last year, to be honest, we hadn't been following it because of the size, and we'd missed the fact a new management team had gone in, It's probably around the time that Andy invested, and things had started to turn a corner. And then it came up on one of our screens and in a conversation with somebody, and they said, look, we've just been to see the management team. You should maybe have a look at it again. It wasn't Andy, it was somebody else actually on the corporate side. And we ran the numbers on it. And although the shares had recovered quite materially from the bottom, I think we were paying 80 odd p when we first invested in September. If you looked at the business, the company had significant asset backing in terms of its working capital and some freehold property. It had cash in the balance sheet. It had the potential to sell the 3D JV to its partner Stratasys for quite a lot of money. And once you strip that out, the underlying business wasn't really being valued at anything. And the management team had come in. They had a sensible plan to reinvigorate the new product development and regain share that had been lost over the previous year and a half to 2 years. So actually, if you're getting to something when the downside's quite low, the upside to us looked pretty attractive. We felt that we could make 3, 4, even 5 times our money at that point. And that's really, I think, the other thing that we look at, Tamsin, is this asymmetric return, a very low chance of losing money, a very, very high chance of making 15% annualized return, but the potential for that return to be higher if all the stars align. And we felt that, Xaar was definitely something that offered pretty interesting asymmetric returns.
And as retail investors, we certainly look who's buying what in the, of fund managers who are particularly good at their game. How much are you looking at what other fund managers are doing? And indeed, how much do you share ideas?
With FactSet and Bloomberg, you've got a pretty good idea of who owns what. And it's always we actually do a lot of due diligence when we look at a company about who else is on the register, because we quite like investing with like-minded people because our interests then are aligned. So I wouldn't say, we don't follow other people in. Andy's got 120 stocks in his portfolio, maybe, or 100. We're not going to own 100 stocks. It's interesting to understand why people own things and what their horizon is. Andy's style is, many small cap managers are growth momentum investors, and there aren't that many people that are, fundamental, more value orientated and like recovery. Andy likes recovery, right? He particularly likes consumer recovery, which we don't like, we don't spend much time on. But it's always interesting, because he's pretty astute in seeing these situations. So, we don't follow him, but it's interesting to see who else is there and why.
So talking about recovery, Clinigen, profit warning, wasn't particularly good. What do you feel about it now? I see that Mark Slater's been buying in. So is it sort of priced attractively now, or is it sit and wait and see?
I think it's an interesting situation. I've been in and out of this company for since 2014, and the rating volatility of this company is like anything in the healthcare sector, and I think that really is symptomatic of I think the market's struggling to understand really what the business does. It's grown through acquisition over many years, and I think the general view is it's quite complicated to understand, both for existing public market investors, but also for any potential acquirers to the company. And it's a very hot space. There's lots of private capital looking at assets in its sector. I think we're aware the business has got some lumpiness in its drugs business. That's been a feature of the company over the last 7 or 8 years. And I think what's happened to them has been quite unfortunate. We always thought that there was COVID recovery potential, which is unusual in a healthcare stock, because all their drugs are used in the in basic cancer therapies, and some of those have been delayed because of referrals being reduced because of what's happened with COVID. I think what took the market by surprise is the timing of the bad news, and I think the management team had been much more optimistic in March and April, and I think that's what's really disappointed and really knocked shareholder confidence in the company. So look, I think there is value at the current levels. I think there needs to be a number of steps to rebuild credibility, and the company needs to reduce its gearing. The company, we invested originally in the company in late March 2020, when in the turmoil, when the market really didn't like the gearing of the company. I think it needs to come down, and it will come down. The free cash flow should generate at least, I think, a 10% yield on the current equity, and the debt will come down through cash flow. So there is a value opportunity in sort of sitting and holding. I think there needs to be some sort of strategic transformation in the business. I think the chairman is due to, I think his 9 years are up in August. And if you look at the voting records of the company, he's a busy chairman, and I think there are a number of shareholders that clearly are not happy. And what we tend to find when change is needed, typically a new chairman will come into a business and typically evaluate whether some of the challenges are management, market or product related, and then what needs to be done. And I think that's probably going to happen in this case. Some cost probably needs to go back into the business. And again, it's a company that has been built up by M&A over the years. There's a question how well all the value has been extracted from what's been bought.
But you're still happy to be holding. Would you have bought today with what's happened if you could have looked into the future?
Well, hindsight's always a fantastic thing. I think at the moment it's interesting. I suspect it will hit our return targets from where we are at the moment. I think there might be some hiatus around board changes and really what that means. But again, it's a business, public information. It's a business that has attracted interest from buyers in the past. There was bid spec from Advent International 12 months ago, and we don't think it's the only PE house that would be interested in an asset like this. So I think it's an interesting situation, and it's. It was one of the healthcare stocks we liked. It was always slightly more risky because of the gearing, but ultimately we're pretty comfortable over the medium to long term. We'll get our return targets out of it.
So which of your holdings are you most excited about?
Well, I think we've talked through a number of them already. I think Elementis we think is a fantastic risk reward from here, great asset backing. In terms of the names we haven't spoken about, I think we really like Chemring. This is the aerospace and defence business, historically best known for the countermeasures business. Which, for those of you less familiar, these are the things that basically send out effectively decoys, sometimes quite unsophisticated, like bits of foil, but increasingly much more electronic decoys, which are used in the defence sector. But under the radar, it's been growing two other business units over the last few years, which are quite exciting. The first is it has a business called Roke, which is a global leader in specialist cybersecurity. Historically, it's been much more focused on the UK customer base, but has just won its first piece of business in the States. And it is a fantastic high quality business with good growth prospects. The second growth angle on Chemring is what are called its programs of record. These are quite significant sort of sensor related pieces of work it's been working with the Department of Defence on for many years. It's already won 3 out of 4 of the big programs there that it went for, and there's another decision pending by the year end. And this, those bits of business really underpin significant improvement in earnings visibility and growth over the next 5 years. So we're pretty excited about that. And I think that we've made good money since we invested, but we still think there's plenty to go for there.
And do you make decisions by sectors at all? You're very healthcare focused now. You've got a very large weighting to it. Was that intentional, or is it just the opportunities came along in those sectors?
So healthcare is one of the 4 core sectors that we invest in, and there's typically about 80% of the NAV in those sectors. Yeah, healthcare was interesting. We significantly increased the weight through the latter part of 2020 into that sector, not because we wanted to be in healthcare. It's just where we felt there were some really interesting risk reward situations. And it was quite contrarian because a lot of people were going to the consumer sector in the latter half of last year. And the 2 assets we really increased there was first Spire Hospitals and secondly Vectura. Vectura was an existing holding, but we tripled the holding in Q4 last year. Very different stories. Spire Hospitals pretty geared, as some of your viewers might be aware, effectively got commandeered by the government in March 2020, and a lot of the elective operations it does were effectively delayed, which obviously impacted the business. Now the government underpinned its costs for the year, but there was quite a lot of uncertainty about what would happen to the business's performance. We did quite a lot of due diligence around the company, and the net asset value of the company, again, property backed, was about £1.80 a share. We didn't quite spot it as early as we'd have hoped, but we ended up buying in at about £1.10, £1.20 a share in the autumn. And, it's one of the companies that's attracted a bid, as you might be aware, which is subject to some debate in the investment community at the moment. So that was a very stock-specific situation in the healthcare sector. The other one was Vectura, which very, very different story, significant net cash balance sheet, a company going through some significant change. There was a sum of parts discount issue, and it was really misunderstood by the investment community. And that, again, like Spire, has, for different reasons, attracted a bid as well. So I think it's probably a temporary factor that healthcare became the largest sector, and it's not by design. It's where we find the opportunities.
And are you happy with both of those bids?
I think, look, in the case of Vectura, it's always disappointing to sell an asset to a buyer that doesn't have synergies. And I think it's probably the lowest price that is acceptable to some investors. And it's notable that there were no irrevocable commitments given by any of the shareholders. Now, we felt that a standalone PE bid wasn't necessarily going to be the best option to maximise shareholder value. We'll see what happens. Hopefully there'll be somebody else out there that sees more value than a standalone bidder. In terms of Spire, I think I should say on Vectura, look, we've almost doubled our money since we invested 3 years ago in a company with significant net cash. So from an investment perspective, it has been a successful investment. It's just always disappointing to sell to somebody with no synergies. I think in terms of Spire, look, it's a really difficult one. A number of fund managers have said that they're not happy with the bid. As you may be familiar, Spire has a 29.9% shareholder in terms of Mediclinic, which is a South African listed hospital group. Mediclinic have committed to sell their shares into the bid. I think it's not a material premium. And as we talked a bit earlier, there's significant pent-up demand to come through Spire Hospital over the next 3 or 4 years with the delays in operations. And Spire has re-energised itself under Justin Ash, the chief exec, over the last 3 years. So we think they're very, very well placed to benefit from that. It's a very difficult one. I don't think it's generous. But again, the shares were trading at less than half the value in the autumn. If the bid doesn't come through, maybe the institutions that want £4 a share are happy to buy a Mediclinic stake off it.
Yes, okay. Moving on, inflation. So we're all facing the prospect of inflation or potential inflation. What are your views on inflation, and how do you think we as investors can plan for inflation?
Well, the perennial debate is the inflation transitory or starting to be embedded in? Look, we're not macro people. We can only go by what we see in our day-to-day lives and also what we hear and see from portfolio companies. Now, if anyone's been shopping recently, the pricing of food's going up, yeah. And it's quite difficult to put a lid on that. I think in terms of our portfolio companies, the last 3 or 4 conversations have been along the lines of companies putting pricing up between 6 and 10%, and those prices sticking. Now, some of that is to recover input costs, and some of it is really seeing what their competitors are doing and to some extent matching them. So is it transitory? Who knows? I think the governments have got themselves in such a mess that actually inflating away debt is probably one of the only ways out. And as long as they can keep interest rates as low as possible, I suspect they're quite happy for a bit of inflation. So I think the second question then is, where is it going to be and where hasn't it come through yet, or where is it starting to come through? A big issue we see is in some of the consumer leisure stocks, which we don't invest in, is labour. A lot of temporary and low-wage labour's gone back to Europe. And from what we hear from the leisure sector, recruiting people is difficult. So I think that there's labour inflation to come through at the bottom end. If you're a restaurant, there's food inflation as well. So I think those businesses, the excitement around that sector is half the high street's closed, there's better site availability, we can roll out better on better rent terms. I suspect that a lot of the economics are going to get swallowed up by cost inflation, and it's still going to be competitive. So what can we do to plan and mitigate against that? Well, I think it's around asset selection. It's the characteristics of businesses that we think means that they're going to be better at withstanding inflation. So can they put their pricing up? Well, that depends on their market leadership and the position of their supply chains. And if you go back to our quality threshold, the things we look for, market leaders, good positions in supply chains, and typically able to put pricing up. So that's how you can protect against it. The second is looking at capital base and asset backing. Now, in terms of capital base and CapEx, the idea is to find companies that either don't need much CapEx to grow, or alternatively are capital intensive, but they've spent CapEx way ahead of depreciation for the last few years. So a good example would be Devro. It's a sausage skin manufacturer. It's not particularly exciting, but it's woefully overinvested, and it doesn't have to spend anything like CapEx along as high as depreciation for several years. So that company's free cash flow is going to be very, very interesting. And if it can put pricing up, the earnings of that business should do pretty well, and the cash flow should do pretty well over the next few years. The final area is asset backing. Again, you go back to Elementis. If you own your own source of raw materials and you've got substantial assets in the ground, that's a pretty good place to be. Where you don't want to be is not being in control of your raw materials and not able to pass on pricing to your customer.
Yeah. Stuart, thank you very, very much indeed for your time today. Tell people where they can find you and where they can hear more about the Odyssean Investment Trust.
So Odyssean Investment Trust has its own website. It's a closed-ended fund listed on the London Stock Exchange, and we produce, like every listed company, interim and annual reports. There are a number of things in there that are probably of interest. Lots of things to do with alignment of interest with shareholders. We Ed and I have got good stakes in the trust, and we also reinvest 50% of any performance fees we earn in buying shares as well. So that's all public information. And there's more information about the independent board of directors who are there to look after shareholders' interests as well.
And to all our listeners, you can find many more educational and entertaining investing videos at piworld.co.uk under the PI Wisdom tab on our newly designed website. Many thanks for listening, and stay well.